Hi there, welcome to Kneppy Invest. Time for another financial year 23 result video. And in this video, I am going to be focusing on the Reject Shop. These companies sell stuff at a discount compared to the supermarkets, which might sound like a good business model, but you just think if the supermarkets exist on really low margins, then the Reject Shop should exist on really low margins. Now, this company's management have to find a way to entice someone like me into their store because there is a reject shop just 500 meters from where I live, but I've only been into this store once since I've been living here, which was 12 years ago. So I've been living here for 12 years and I've only been into the reject shop once. I go or walk past their store about once every 2 days, and every single time I look at the displays in their window, I see something that could be enticing, but I never go in. So the management have to solve that problem. I have no idea why I don't go in, but the management have to solve that problem. How to get people like me, consumers like me, into their stores. Uh, anyway, so 10 years ago, when about 3 or 4 years after I started investing, I took a look, did a bit of research in this company, and I thought, yeah, this company might have a really good business model. Then I took a position in the company. Share price at that point in time was around about $15 to $18. And I quickly sold out of my position in 2013 for some reason. I can't remember why, but that was a really good decision because if you look at the chart, share price high and the valuation of this company was at its highest 10 years ago. So that's not the story you want to hear if you're a long-term investor of a company. Now, typically, when I first start researching a company, I look at their revenue history and then I go from there. And the reason I look at the revenue history is simply because I want to determine what the quality state of the company is. If a company can increase their revenue at a pretty good rate over time, there's a better chance that company is a high quality company. If a company can't increase the revenue all that much, or if revenue is going down, that's an indication that the growth of the company has come to an end, or the company just can't grow, and that's a serious red flag. Now, in this video series, what I typically do, maybe not typically, always do, is look at the financial year results. Then I have a look at the revenue history, and then I look at their chart. In this video, I'm going to do it complete opposite. I'm going to look at the revenue history of this company first, look at the chart, determine whether this company could be considered high quality or not, and we already know the answer, and then we'll have a look at their financial year 23 results. And I might be a little bit biased because I already knew how I would classify this company in terms of quality. Reject Shop is a low quality company. And the reasons behind why I think that is obvious when you look at the revenue history and the chart. And to be honest with you, if you just look at the revenue history and the chart of a company over the past 10 years, you can determine the quality of the company just by doing those two things. So let's do that right now for the Reject Shop. And here is the revenue history for the Reject Shop going back 10 years. Not only the revenue history, I've also included gross margins. You'll notice I've not included income or cash flows because we can draw a lot just by looking at the revenue and gross margin history. Now, one thing I prefer to look at is revenue per share history over revenue history, because when you look at revenue per share history, you exclude the effects of share buybacks and also any sort of capital raising. So I prefer to look at revenue per share history. And if you do look at the revenue per share history of the Reject Shop over the past 10 years, you get a negative number. In fact, revenue per share has decreased at 1.5% per year over the past 10 years. If you just look at revenue, you just see that revenue has not been increasing all that much. In fact, you could argue revenue is flat, remaining around about $800 million over the past 10 years. In fact, the lowest revenue was in 2014, went up to $800 million in 2016, and has been remaining around $800 million during the past 8 years. Now, the more concerning thing, in my opinion, is gross margins. Gross margins have been falling, and they fall, it seems like, every single year. They reached a peak in 2015 at 44%, and for the first time in 2023, gross margins fell below 40%. And that's going to have an effect on income or profits, because if they can't increase revenue and gross margins are decreasing, there is a greater chance that the profit for this company has been decreasing over the past 10 years. And that's definitely true because if you look at the revenue history over the last 10 years, the revenue or the income or profit high point was actually 2012. So I'm going back a little bit further with 22 million. But if you look in just the last 10 years, the profit, record profit over that period of time was in 2016 at 17 million, and it's been dropping ever since. A nice little uptick in profit in the past year, up to 10.3 million. We also have seen a negative number, negative 17 million in 2019, and between 2020 and 2022, profit for this company was below $10 million. And the reason why we have seen profit for this company dropping is because of the decrease in gross margins. Net margins have been decreasing. Operating margins have also been decreasing. So some serious red flags when it comes to the reject shop over the past 10 years, just by looking at their financial history. So typically that's where I stop researching a company. I look at the revenue history, look at the gross margins, and there are some serious red flags. So straight away, this is not a high quality company. And if it's not a high quality company, the only way I will take a position in the reject shop is just a trading position. So a short to medium term trade if I see something good on the charts. So we'll have a look at the charts in the next slide just to see if there's anything good. But another way you can determine a quality state of a company is just by looking at the chart. So let's have a look at the weekly chart, the 10-year weekly chart for the reject shop, and see if you can determine the quality of this company just by looking at the share price action over the past 10 years. Yeah, so is this a high quality company or a low quality company based off this 10-year weekly chart? So the share price high for this company was back in 2013. So we're talking about 11 years ago. I keep forgetting this is 2024. So we're talking about 11 years ago, share price of this company reached a high of about $18. And you can see the share price has just been falling ever since then. A lot of volatility in the share price. So this is why this company is more of a trading company, trading stock, if that's what you want to call it, instead of a long-term investment, because this is exactly the opposite of a chart you want to see for a high-quality company. So for a high-quality company, you want to see the share price going from the bottom left to the top right. This is going from the top left to the bottom right, the exact opposite of what you want to see. Now, if you do look at the last, say, 6 months or so, you could argue that there is a short to medium-term trade here. But that is an argument for another day. Now let's have a look at the financial year 23 results for the reject shop. The revenue, 819 million, up 3.9% from last year. So things are moving in the right direction for revenue. Nice increase. Profit, 10.3 million, nice 30.5% increase from 2022. But you can just see, if you compare profit to revenue, this company exists on really low margins, not gross margins, 39.9%. But this company spends a lot of money on leases. And you can see that when you look at the operating cash flow. So this company reported operating cash flow of about $110 million. But that does not take into account leases. Leases for this company are really high. And I don't know why they've made the changes. They made some accounting changes about 5 years ago where they excluded leases from the operating cash flow. So they put it into another area. So a lot of these retail companies seems like they have a much higher operating cash flow than they did, say, 5 to 10 years ago. So you have to keep that into account. But I always like to take leases away from the operating cash flow to get a true sense of the real operating cash flow for a company like this. And the true operating cash flow for the reject shop was only 14.7 million, which was a little bit higher than the profit, but free cash flow only $2.6 million. So what you do with the free cash flow is you take the operating cash flow minus the leases, minus that capital expenditure, and you get 2.6 million. I'm not sure why this company has a high capital expenditure, which would be about $12.1 million, but it's there. Now, one positive about this company is they have net cash of $77 million, which does seem quite high for this company. But the other thing I should also point out is some people will include leases in debt. And if you include leases in debt, this company has a much bigger net debt than net cash. So it's all what you do with leases that will change whether you consider this company has net cash or net debt. Reject Shop only has 38.4 million shares on issue, which means at a share price of $5.39, and I'm going to have a quick look at the share price right now because I'm recording this video about 2 hours after trading has begun on Monday, the 5th of February. Market is down 1% right now, and share price of Reject Shop is $5.24. So a little bit lower than what I've got here, but you always have to take into account that the share price of a company like this could be quite volatile from one day to the next. So market cap roughly about $200 million. So if you take into account the cash balance of this company, Reject Shop has an enterprise value of about $130 million. Equity, $181.9 million. So that's roughly where the market cap of the company is. But if you do calculate return on equity and return on invested capital, you get really low numbers, much lower than what I would like to see. And this is another indication that this company is not high quality. Return equity 5.7, return invested capital 4. Another thing I like to do is just look at the return invested capital and return equity history. Now, if you go back to the start of the 2010s, this company had a return equity of 30, and return equity has been dropping ever since then. When it went to 20, down to 20 in 2013, down to between 10 and 12 between 2014 and 2016, and then below 10 in 2017. So return equity and return invested capital have been dropping over the past 10 years. And that is another significant red flag. The company also has a dividend yield, 1.2%. Have they been issuing dividends consistently? That's the other thing I'm just going to look at right now for the Reject Shop. For some reason, Comsec is not wanting to open up the dividend history of this company, which is annoying. And no, so this company did not issue a dividend to the shareholders between 2019, 15th of, the ex-dividend date was the 15th of March, and they also issued a dividend on the 19th of October 2023. So there was a 4.5-year period where this company did not give their shareholders a dividend. So you also have to take that into account. Now, a positive sign, green flag for this company is they are now paying their shareholders a dividend. That could be a good sign moving forward for this company. But overall, many red flags for the Reject Shop. The next two slides, I'm going to show you a couple of interesting things I found in the company's balance sheet, this slide, and then the cash flow statement, the next slide. The first interesting thing I found in the balance sheet was a substantial increase in inventories, a $22.1 million increase in that. And that will have an effect on the operating cash flow because this is a significant change in working capital. The other things you have to look for in terms of working capital changes are trade and other payables and trade receivables. There was not much change in trade payables, and trade receivables is not actually mentioned in the balance sheet. So keep that in mind when we have a look at the balance sheet. The other thing I like to look at in terms of balance sheet is lease liabilities. You can find it under current liabilities and non-current liabilities. And this company has a lot or fairly high lease liabilities. In current liabilities, it's at $84.3 million. And in non-current liabilities, lease liabilities at $144 million. So combined, $228 million in lease liabilities. So this company is spending a lot of money on rent. They might have a lot of stores in Australia, and those stores cost a lot of money to run just in terms of rent. Now to the cash flow statement. So remember I talked about lease liabilities or leases, and you have, in my opinion, you have to take that into account when you look at the operating cash flow of a company like this. So if you look at the cash flow statement, the net cash inflows from operating activities, $111 million. And just think, this company has a market cap of $207 million and enterprise value of 130. So if you just look at the operating cash flow of this company, you think, wow, this company is trading so cheap. So I always like to look at lease payments. And you can see that in the cash flows from financing activities. This is an ongoing cost to run the business. That's why I believe it belongs in operating activities. So last year, the principal elements of lease payments was $95.3 million. This year, it was $96.3 million. That's why in the way I calculate operating activities cash flow, I include lease payments, and that's how I got around about $14 or $15 million. And cash at the beginning of the financial period, $77.5 5 million. The other thing to take into account here is any sort of interest you're paying. Income tax is fairly important. This company doesn't have much income tax. In fact, income tax received instead of paid, which is something you also have to take into account. So they're not paying tax. Payments for shares bought back. So this company is undergoing a share buyback, $2.7 million there. But a lot of cash on hand, 77 million. If you go back to this particular slide, the balance sheet, the other thing I should point out is I always look at any sort of debt. And apart from lease liabilities, no significant debt. That's why I say this company has net cash of 77 million. For those who like to include lease liabilities into the debt section, you'll probably say this company has net debt of around about, well, 228 million. So about 150 million. So you can see there's a significant difference between how you calculate or how you end up calculating net debt or net cash by how you deal or treat lease liabilities. Now let's have a look at the valuation metrics for the reject shop. And to be fair with you, none of these are enticing. P ratio 20, meh. Now you might say that the earnings of this company could increase fairly significantly in 2024 from 10 million. You might say that's a low base. They may be able to get their profit up to 15, maybe even 20 million, which would mean the P ratio would decrease if the share price stays where it is right now. Maybe that's a fair argument, don't know. But I would prefer the P ratio to be a little bit lower than 20. Price book ratio 1.14, probably prefer that to be below 1. But again, semantics. I would say PB or price book ratio of 1.14 is not low or not high for this type of company. Now, when it comes to EV to operating cash flow, 8.8. That's sort of in the range that I am looking for, between 6 and 10. And it's all, you're going to get completely different numbers in regards to the EV to operating cash flow, depending on how you deal with lease liabilities. Now, the EV that I used to calculate EV to operating cash flow was 130 million. Operating cash flow was about 15 million. Now, if you include lease liabilities in debt, you'd have this company net debt of 150 million, which means the enterprise value of this company would be about 350 million. But if you did that, you'd have to maintain operating cash flow of around 110 million. So if you actually did that, the EV to operating cash flow of this company would be between 3 and 4, which is significantly lower than 8.0. So depending on how you deal with lease liabilities, you might say EV to operating cash flow of, say, 3.5 is really enticing. So that's maybe fair if you go down that route. Free cash flow yield, 1.3%. But again, it's how you deal with lease liabilities is fairly important to that particular calculation. Also did a reverse TCF. That's just like how much would the operating cash flow or free cash flow of this company have to increase from here to justify the current valuation? 8.1% per year. This company might be able to achieve that over the next 5 to 10 years. That's possible. I would prefer that number to be negative, to be honest with, if I'm honest with you, for the reject shop. But just because I don't think there's much growth in this company over the next 5 to 10 years, unless, this is big, unless new management come in, they see the potential of this company, they devise ways to entice me into the stores and consumers like me into the stores. And who knows, that could happen. All it can take is just a change in management, a new CEO, maybe a young CEO who sees the potential of this company, sees a different business model evolving over time, and that's when you can see a significant turnaround story in a company like this. Next 5 companies I plan to do in this particular series are ResMed, Halix, Sonic Healthcare, ReadyTech, and AGL. And after that, I have more here. I have about 15 companies to do after that. Those companies include AVA Risk, Clinuvel, AIM, have no idea who that is. A1M, not AIM. AIM is AI Media. EGL, which is Environmental Group. HZN. What is HZN? Self Wealth, Swoop, Judo Capital. Looking forward to that. Beam, People In, and RXH. Is that Rewardle? I can't remember. Anyway, So those are the companies I'll have to do after these 5, and then I'll be done with this particular series, and then be able to have a look at half year and full year results that are released in February. That's all I have for this look at the Reject Shop's financial year 23 results. If you have any thoughts about this company, if you're a shareholder of the Reject Shop, or if you are someone who goes into the Reject Shop quite often, I'd love to hear your thoughts on why. Why do you go into these stores? Is it just because the stuff they are selling are cheaper than the supermarkets, that sort of thing? Or maybe you just like the customer service? I don't know. So I'd love to hear your thoughts on the Reject Shop. So leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.